All right, well, welcome to the April edition of our Economic Update. I'm John Cleaver, partner, senior financial advisor at Beyond Wealth.
I'm Dennis Bacon, Chief Investment Officer at Beyond Wealth Advisors.
And we're back again. It's April, and here we go. So the markets have had a little bit of a rally. Interestingly enough, both stocks and bonds have actually got out of the gate first quarter, maybe a little better than expected. So what's going on?
Well, just kind of to give a quick summary of it, really the worldwide market indexes in March were up almost 7.5%.
Yeah.
And the US was right in line with that. The surprising one was Europe was up over 12% for the month of March, with Asia kind of lagging a little bit.
Right.
And actually, what we saw in the bond market was part of the interest rates mitigating a little bit, kind of dropping a little bit from their highs, and that has caused the bond market to be up about 3% for the quarter, which was probably one of the best performing quarters since 2020. So it's an excellent quarter after the rather dismal year last year. It was really good to see. The other thing that was interesting is the commodity prices were generally down over 6% on average, with the major exception being precious metals, which were up about 5.5% for the month of March.
Wow.
So we have a lot of moving parts in here as we look through things.
Sure.
So it's been kind of interesting.
Well, that's great. So in that summary, you mentioned that both stocks and bonds were up. Typically we think stocks go up, bonds go down, stocks go down, bonds go up. They tend to work in inverse to each other and maybe provide some ballast for each other. That's not what's happening right now.
It really hasn't happened for the last year, year and a half. And probably the biggest reason, last year we had an extraordinary rise in interest rates.
Right.
And bond values are based upon two things: the underlying value of the companies and the stability of the companies themselves, and what the interest rates are doing. Right. So if interest rates go up, the value of your bond goes down. Last year, with the extraordinary rise in the Fed, has risen interest rates from basically 0 to about 4.75 in the past 9 or 10 months. That was what's been the drag on the bond market. So that's been difficult. At the same time, the equity markets were looking at projecting what the Fed was trying to do, which was basically create a slowdown in the economy. And so they were assuming that things would do poorly. That's what happened in 2022. In 2023, what we have seen is a bit of a robust recovery, particularly in the technology and communication information area. Both those areas have done well. Those are the high growth sides of the market. At the same time, there still is a fear factor that we're going to go into a recession.
Right.
And that causes a flood of money into the bond market, and particularly out of cash into the bond market. So we haven't had the pullback in the equity market where people getting out of there, but we've had people going from cash and driving the interest rate on bonds down because of the bigger demand. Right. So that's kind of what's happened recently. And I think that's probably the biggest reason. This is a short-term thing on seeing this, them paralleling each other as opposed to diverging.
Right.
Yeah.
Right. So speaking of the economy, we're kind of seeing a few mixed signals right now. So if we think about things like manufacturing, which actually has shown many signs of contracting, and maybe more so than it has recently. We think about unemployment. Unemployment's actually ticked up a little bit. We've seen signs of more layoffs, things like that. And then inflation, although inflation has come down some, maybe mitigated some, still over 6%.
Right.
So those are some kind of negative drags on the economy. On the other hand, housing's actually been pretty resilient. We've actually seen some positive growth in the housing market. Housing permits have been up. Housing values have been up. And the consumer continues to spend in ways. So help us unpack that a little bit. When we talk about the economy, some things showing us going down, other things looking pretty well.
Okay. First, let me address the housing market first. We have had, over the past, really since the financial crisis in the late 2018, 2008, 2009, that time frame, we have had a shortage of housing in America. And what we're seeing right now is we're seeing all of the people in their 20s coming of age, if you will, and getting out and buying homes, and that demand is still there. What's helped is the year-over-year rise in house prices only up 2.6%, which means we've had a drop in house prices in the last quarter in a lot of different areas. It varies by region of the country and even from town to town. So we have seen that as interest rates have went up, some housing prices started to drop modestly, not a lot. And that has helped the demand come up a lot, and I think that's a lot of the issue in the housing area. But we are continuing to see a choppy economy.
Right.
I think it's going to continue that way. And what we're seeing right now is we're seeing rising prices and rising interest rates. And we've also seen the reason why the unemployment situation is we have a lot more people seeking employment right now. Literally, the participation rate has increased in the last couple of months, primarily due to this need for more money in households, and that's inflation driven. So that plus the layoffs is creating a lot of flux in the employment market. Ultimately, with the rise in prices and all this stress on the consumer, ultimately, we're going to see a decrease in consumer spending.
Right. Eventually.
Eventually, yes. It may not be in dollars, but it will be in the number of goods purchased.
Right.
Because they cost more, you can purchase less.
Right.
And ultimately, this should result in an economic slowdown.
Right.
I expect it to happen sometime during the third quarter, maybe a little earlier, but I expect there to be that time. And how that relates to the stock market is kind of a predictor of the future.
Right.
But there's going to be a point in time here. Typically, when you go through a bear market, which we have somewhat been in a modest bear market, really, it's not as bad as what I've seen in the past, but when you go through a bear market, eventually you get to that point where there's what we call capitulation, where people just say, I can't take this volatility anymore, I'm just going to step out. It may not be a big capitulation, but we have not seen that really, except back in March of 2020 during the COVID situation. We saw that capitulation in one day, and we saw it amongst our clients, we saw it amongst the whole economy, everything, somewhere around March 20th, I believe. Right. And it's around, yes, I'm pretty sure that was the day, maybe it's the 21st, I'm not sure, but right in that time frame. I expect to see that capitulation at some point in time that will signal the end of this bear market cycle. Right. I expect that to happen this year, probably in the third quarter. It could be a little later, could be a little earlier. My crystal ball doesn't work very well, so I would expect it at some point in time. But until we see that, I think we're still going to see choppiness in the market. But otherwise, we feel fairly positive once we get out past the next 6 to 8 months.
Right. Well, fantastic. All right. So, that was a lot of ground that we covered in a pretty short amount of time. So, with that, we just want to say thanks for tuning in again. Make sure you reach out, talk to your advisor if you have specific questions. Obviously, as you mentioned, it is a little more volatile, a little choppier right now. So, if that's causing you any concern, be sure to reach out and have a conversation, and we'll talk you through that. So, with that, I think we're good.
Thank y'all. Y'all enjoy the coming spring.